Let's talk to Federico Bentley. He's a sales trader, account manager at Ayondo. Very good morning to you, Freddie.
Good morning.
Right, we've got a mind-boggling 9 slides this morning.
Yeah,
Quite excited about this. Just before we go into this, somebody's watching for the first time. Okay, what is Ayondo all about?
So Ayonda, we offer two platforms. We offer the social trading, very similar to managed funds, and now we've actually got a portfolio management license. So it's I guess tight regulation and so on. And what we offer is sort of copy trading. So if you're too busy at work, you can just emulate a top trader's performance. And I guess if it's for UK, if it's falling under a spread bet, you're not paying any capital gains on your profits.
Yep.
And on the other side is just your standard sort of either one-to-one trading, very similar to with your bank, and just your leverage trading. So we offer a variety of products.
Understood. Okay, well let's go into some slides and go into some detail. This is a client of yours. We've seen his performance before. What are the key things? I always look at the risk score.
Yeah.
One is the best.
It's
right?
the lowest. 1 is the lowest, 10 is the highest. It looks at sort of a variety of, risk factors. The overall, risk that you're taking. Especially with the leverage factor and the amount of trades that you have open. Your career level, which you can see that he's got level 5. So you've got the 5 flags, which normally takes over a year. So he's got a very low risk score. He's more of an equity trader. You can see his graph is very steady. He's been trading with us for last over 2 years now, looking at anywhere between 10 to 15% a year. And he'll just hold Commerzbank, Deutsche Bank, the 30 equities within the DAX. But what he does to hedge himself is on the intraday, he'll just short the DAX. So these stocks do come down in price and the DAX does fall. He's not just losing out on those equities, he's actually making money on the actual indices.
Yep.
You can see he's returned 20%. Low volatility, low drawdown of 7.41%, which is actually done in unrealized terms. So this is including the unrealized losses that he carries.
Positions.
Exactly. So it's giving you a fully transparent overview, of his performance.
Okay, well, part 2 of that is this is his 2018 performance. What are the key components there?
Exactly. January obviously was a record year for a lot of the indices. He was still holding the equities, so he's up about 0.3%. February is where I'm most interested really, is obviously when there was that mini correction, overdue correction, you could call it, just shy of 10%. And he was only down 0.81%.
Yeah.
Which is good to see. A lot of other, a lot of traders, a lot of, the hedge funds overall had a fairly big drawdown that month, whether it's 10, 20%. So it's good to see that he was sort of outperforming the indices overall,
And this month he's down just a smidge over.
Yeah,
1%.
exactly. I guess it's a carry on, from some of these equities that are still sort of taking a bit of a loss, but nothing serious, So for the year, it's fairly low.
Understood. Okay, well let's move on then to the ISA alternatives with Ayondo. What are the key components there?
Yeah, it's a little bit different to the social trading, but a lot of people think we're just a social provider.
Right.
Obviously, with the ISAs coming up, they're ending. The deadline is 5th of April. And a lot of people don't realise what Ayonda offer is that 100% margin. So if you're holding a stocks and shares ISA with Hargreaves Lansdown, whoever it is, the maximum you can put in is only 20 grand a year. With Ayonda, you can utilise us as well by using the 100% margin, where if you're holding Barclays, HSBC, even if it's a US, Apple, for example, you can use us for 100% margin. So you're not actually trading on leverage. So there's no financing cost. You're not exposed to sort of a margin call, and you're just not trading on leverage. So you haven't got that excessive risk, some people are wary of. And the benefit of doing it through Ayondo is, again, you're not paying any tax. So any profits above that 11,200 allowance is tax-free. Usually you're paying anywhere between 10 to 20%, depending on how much you're making a year. And you still receive 100% of UK dividends and 85% on US dividends.
Okay.
Some brokers, such as Hargreaves Lansdown, they still charge you monthly fees.
Yep.
So in around 10 quid a month, whatever it is. But with us, the only cost is the spread. So when you're actually trading.
Okay.
And there's no cap. With an ISA, it's 20 grand a year. With us, if you have more and you're sort of over that deadline of April and you want to start in May, June, whenever, at least with us, you can start with whatever you're capable of. If it's 100,000, a million, there's no limit,
Right. Okay, so let's talk about non-margin trading.
Okay, so here on the left, you can see this is just a spread bet. If you're doing it with 10% margin, so you're only, if you're borrowing 90% of the margin, here is £10 a point, equivalent of 10,000 shares. So if you can see there, the sell-buy price, but the main bit is the trade value and the margin. So if you're doing it as a margin trade, you can see that the trade value is 2,115, but you're only putting down to £215.
Yep.
So that's on margin because you're only putting down 10%. If you wanted to do it one-to-one,
Yep.
on the right you can see that you just slide the effective risk factor to 100%, and therefore the margin required and the trade value is exactly the same. So £10 a point, 1,000 shares, and you're paying no tax, and you're still receiving 100% of dividends. So a lot of people, they might use Saxo Bank, for example, to do their one-to-one trading because they don't think that other platforms offer it. But with a lot of people, they don't realise that you can just slide that margin to 100% and you're not trading leverage. So you get no margin call, no financing, no overnight fees. It's just a one-to-one, just like a normal cash equity.
So you've got a choice there of effectively doing what I used to call an old agency trade.
You're technically not getting any voting rights, but if you're not owning more than 3% of the stock, then why would you care about voting rights? You still receive dividends and you don't pay any tax.
Yeah. Okay, so let's talk about hedging. This is a favourite subject of mine.
Yeah.
Tell me about this.
Well, I guess in the last 10 years, it's been a massive bull market. Last year, a lot of the markets across the US, the Nasdaq was up 32%. Dow Jones up 26%, S&P 20%. So it's kept on going. But once the markets start falling, we had a bit of an overdue correction in February 4th, and the markets fell just shy of 10%. I guess people start to think, how can I protect myself from a potential downfall? So here you can see if you're holding Apple, value shares, I guess, and you want to sort of hedge yourself, you can simply just short the actual index. You can either do it as a future, or you just do 100% margin. So you can see here on the left, we've got the S&P, and on the right, we've got the FTSE. So if you are looking to short it, in case there is a correction of 20, 30%, you can simply put the margin to 100% and just hold that. So even, you know what your maximum risk is. And again, if you are right, you're still not paying any tax. And I guess you're hedging your other positions elsewhere, especially if you're holding stocks.
Okay, well that seems quite sensible because historically a lot of brokerage firms before didn't give the ability to go short to basically delta hedge and the likes.
Yeah.
So that looks good to me. Okay, so let's talk about ETFs and bonds. Clearly, you've got a number of instruments you can
right now I guess there's about 20 there that we can always add more as well. But I guess when you're coming to different brokers, you think you can only trade FX, indices, whatever, or stocks. But with us, you do have a diversity of products. We obviously have both ETFs and bonds. So if you're more of a passive investor, you can just hold a few ETFs tracking whether it's the Nasdaq or it's some biotech sort of ETF. And again, looking at bonds, of course, you've got over in the US, you've got Jerome Powell mentioning that he may increase interest rates 4 times instead of 3 times. So obviously with bonds, they have an inverse correlation with interest rates. So as interest rates go up, bonds should technically fall. Bonds are correlated with the stock. So bonds go down, stocks should technically go down. So again, you can also short the bonds. So if you're having you've got your money in your bank and you're making 4% a year, you can always hedge yourself and just go short on a particular bond, whether it's a bond, and make, I guess, a safe hedge on that side.
Okay, let's talk about protection in bear markets.
I mean, same in any fund. If you're with St James's Place, you're always going to have X amount of fixed income, X amount in property, commodities, cash, and equities. With us, again, if you are worried about, I guess, what's happening in the future, you can always have some type of hedge in gold. You can buy the future, or you just do one-to-one with 100% margin. You can look at sort of buying different safe havens such as the dollar, Swiss franc, and the VIX, which is quite interesting that we saw on the February 4th that the huge move that the VIX had is up over 100%. When the rest of the markets did fall, just shy of 10%.
Yeah.
So if you're looking at that, right now it's trading probably around 17.8, and it spiked up to about $31. 2008 spiked up to $60. So when you see these big sharp falls, the VIX does obviously tend to go up. So it's something maybe to think about having in a separate account possibly.
Okay, we're talking the inverse relationship between the equities and the VIX. If we move on to the next slide.
Here you can see obviously February 4th, the big movement that we saw. The Dow had the biggest point drop in its history. Obviously next day it recovered about 1,000 points. But if you look at the VIX, it spiked up over 100%, which is a big movement to have. So if you are holding, some value shares, Apple, Amazon, whatever it is, even Barclays and your safe banks, you would have, had a bit of a squeeze there. But if you had a hedge on the VIX, you would have had a pretty good, I guess, remuneration on that side.
Yeah.
So it's something to think about, just to keep it diversified. There's no point putting all your eggs in one basket.
The textbooks will tell us that every day of the week, won't they?
Exactly.
Right, let's wrap up with, in terms of the insurance policies, again, I think that's pretty important because I'm risk adverse. What are the headlines here?
Yeah, well, I mean, with each broker, you usually have coverage of up to £50,000 by the FSCS. With Ayonda, what we've done, we've actually increased our insurance policy directly through Lloyd's in London, underwritten by QBE. That covers you up to £1 million. It was before 500,000. Now it's been increased to £1 million. And that just means if anything happens to a broker, obviously there's more scrutiny under the whole industry, and if a broker does go into administration, at least with us, we covered up to £1 million. So for people who have slightly higher account balances, we can always increase this figure, but at least you have more protection. Obviously with the new regulation, and as we're coming out in the summer, the FCA is always scrutinising the overall market, which is understandable, and I think it's best for the market. But it's also nice to have that protection, I guess, and peace of mind.
Finally, we're obviously 9 years into a bull market.
Yeah.
You've talked about some protection in terms of the markets.
Yeah.
Are lots of people inquiring about? Do you get the sense that people are getting quite bearish?
Yeah, I think they're not bearish, but they are thinking of ways of how they could potentially hedge themselves. We do have a lot of clients from all around the world who are thinking about how to potentially, buy the VIX, buy gold. Even Irish clients who, over in Ireland, you pay 33% capital gains. So now they're starting to move to us instead of using their bank, where they have, anything above 1,200 profit, they've got to pay 33%. So we're getting a lot of more, I guess, attention on how to utilise both the tax benefit and, I guess, hedging your portfolio.
On that note, Freddie, good to see you.
Thank you very much.
For your time.